I think working on yourself as you work on your money is just as important. I think networking has provided me all the opportunities I've had today. One bad deal where you didn't have integrity.
Welcome back, investor. We got an episode of Passive Income Adventures. If you're new here, it's a place where we talk about lifestyle design, like how to have more passive income adventures and trying to figure out how we're going to pay for it through investing. Passive income is not running a business that you start and then only occasionally babysit. That is not passive income. Passive income is where you invest money into something and you do no work in order to receive a return on that money. Similar to what we're doing in the stock market. So we've got Avery Robertson today with us from Blackfoot, Idaho area. Say hello, Avery.
Hello,
President of tell me the name of it, the Idaho RIA? South
East Idaho area.
East Idaho RIA. So the RIAs, for those of you who don't know, Real Estate Investor Associations, it's a national organization and you can license a chapter through them or just license the name and basically get a group of people together, club to talk about real estate investing. And the RIAs were really formative in me learning and networking early on. And still, even today, I still go to 7 years later and meet new people almost every single time. So we're going to talk about the impact of having a great group of people around you. Avery's doing a hard money lending similar to what we're doing. Also some equity deals. You said a mobile home park and you just
A
picked up
mobile home park and an RV park.
RV park. And are both of those in Idaho?
One of them is in Nebraska, and the RV
Okay.
park is in Idaho.
Okay. And the RV park, you just closed on it, what, like a couple days ago?
Yeah, January 31st. So
Nice.
we're just getting started.
Okay. So I definitely want to do a little bit of a deep dive into your business plan on that one. I'm familiar with the park. We drove through it. It's near where my husband grew up and really would love to hear what you guys are planning. But let's start off with just by having you introduce yourself. Tell us what you've done, what you're doing, and what you're planning on doing, and take us through just your beginnings, like how you got into starting to be in investing, day job versus being a full-time investor, when you got involved with the RIA, just start at some of the turning points that got you from just a normal guy into investing superhero.
Not sure if I'm at the superhero level yet, but we're trying. So yeah, we'll start at the beginning and just jump in whenever. I think I've always had an interest in investing and entrepreneurship, but I wouldn't say I'm very aggressive and didn't really know where to put my efforts either. Thinking back a long ways, I remember opening my first bank account with my dad, and the guy at Bank of America was like, "Yeah, there's a kid in here that came in and opened up the CD. He's the smartest kid I know. He can do so well." And I'm like, "Well, what's a CD? No, I'm the smartest kid. What's a CD?" And so I just had that interest in which CDs haven't been good for a long time, but just that concept. In college, we went to BYU, Idaho, and did an ag business degree. In a lot of the finance classes, we talked about investing and compound interest and Roth IRAs. Anxious to get started on it, even though I didn't have any money. I remember calling some financial advisors and saying, "Should I open up the Roth IRA as I'm graduating?" None of them wanted to mess with me as I was broke and out of college, but just had that interest. I had an internship in Texas on a ranch. I remember I spent a lot of time just in a backhoe actually and
Yeah.
had a radio. And I remember Dave Ramsey came on stations there and
Yep.
listened to him every afternoon.
Yeah. Me too. I lived in Austin for 20 years and the evangelical community in the South they're big Dave Ramsey fans. And I was actually just thinking about this morning, like, I'm not really sure if Dave Ramsey helped me more than he hurt me. I think there's just a lot left on the table with that plan. Once you get to baby step 4 or 5, you're like, let's jump ship. But everything before that, I think is good. But yeah,
Yeah,
basically put my financial teeth on Dave Ramsey as well.
it seems like a common theme sometimes. It's like I say, you go from Dave Ramsey to Robert Kiyosaki. Or
Yeah.
yeah,
They're actually
and
I heard Robert Kiyosaki once in an interview with the Nomad Capitalist saying that he and Dave Ramsey are friends. And he's just like, just let me tell you, Dave Ramsey doesn't do everything he teaches you to do. And I was like, thank you.
yeah, but he's staunch in what he teaches, and for the everyday American, and for getting those first few baby steps, it's a good
Mhm.
place to start
Yeah.
for
I mean,
business and
like
growth.
Alcoholics Anonymous is a really good example of people who are addicted to alcohol. You can never touch alcohol again. You need to go to these meetings and you stay far away from any situation that makes you think about alcohol. I feel like Dave Ramsey's that guy for debt. And I just am not addicted to debt and spending. And I just feel
For
like it
sure.
was just overkill. It just wasn't something that I really needed that much of in my life.
Absolutely. It seemed, I don't know where, but somewhere from there. So after we graduated from, my wife and I graduated from college, we moved to Florida and we're
Mhm.
working on the cattle ranch. And it feels like somewhere in that time I discovered Bigger Pockets and just was listening to this. And I need to do a house hack. I need to buy
Mhm.
rentals. And we got up here to Idaho a couple years later. And I was working for a bank at that point, part of the farm credit system doing farm and ranch loans. And on the side, I was just actively trying to find either a house hack or something. My wife, both were on the same page as far as the idea, but just never got on the same page as far as the right house hack or finding a rental that made sense.
Yep.
And the market was heating up and cash flow was poor. And I was going to all these RIA events here as well and trying to figure out what other people were doing. And then it seemed like everyone was mostly flipping homes. So I was like, well, maybe that's what I need to do. Then I started doing direct mail and trying to find a flip. And I talked to a lot of sellers, but I never got a single place under contract.
Oh, yeah.
And this felt like I wasn't really getting anywhere. Looking back, I mean, if there was few opportunities on some buy and hold places, but I just never pulled the trigger quick enough. I guess you could say like kind of analysis paralysis to a point too. I was
Mhm.
taking some action, but just not enough. And then I met a guy out of Utah that presented about hard money and he was funding quite a few of the deals up here and it clicked. There was kind of seeing at the bank, how banks leverage other people's money. They leverage your deposits to lend money, make a spread. And then I knew how to analyze loans. And so I gave him a call and I just said, hey, I think I want to do what you're doing. I'd be competing against you up here, but would you be willing to teach me what you and how to set this up? And thankfully, he was super cool about it. Open book. And he actually just kind of opened the door and said, hey, do you want to invest with me on a deal first? Then you can see if you like it, see what it's like. And I said, yeah, let's do it. And so I had about 80 plus thousand on a HELOC.
And you
And
were just so this wasn't money you were saving up from your job. This was from a home that you purchased as a primary home?
yep, this was my primary residence.
You
I had saved up to that point. I had been really aggressive with my 401k.
Mhm.
So I had quite a bit of money in that. We put a good down payment on our house, but that chunk of change was this line of credit on our primary home.
Okay. So you were able to take the HELOC out against a personal home, which when you think about it is a kind of another form of house hacking. You can't rent out your basement or your attic because the home that you choose sometimes it has to be where you want to live. And sometimes it's just the floor plan and the location is just not suitable for house hacking. We did something similar in a house that we bought in Utah where I used to joke that we were renting it from the bank. We got an interest only HELOC on it, no mortgage. So we put 10% down and they basically loaned us $500,000. We had some equity in there because of our 10% down, and we would just keep recycling that money. I would say I'm basically renting it from the bank because we're not building up any equity because I keep borrowing against it every time I pay it down. And we can't get
Yep.
at the natural appreciation because it's capped off at what they loaned you. So it's 485. And even though the house was worth 550 and then the next year it's worth 600 and then it's worth 650, we couldn't get any of that equity without refinancing the HELOC. I just felt like I kept recycling that same 10% down over and over again until basically we hadn't built up any debt paid equity, but we had appreciation equity. I'm like, okay, so I get to paint the walls what color I want. I can have a dog if I want. A landlord can't tell me when to move out or come over and check my property whenever because we rented around the corner and our landlord was in our house one day. I'm like, dude, what are you doing here? This is not okay. Because
Yeah.
he had to come get something that he left in the garage. And he didn't even tell us. I was like, okay, renting is not for me. So we're renting our house from the bank through this HELOC and because we weren't from the town or it wasn't like my grandpa's house and in the middle, we're just barely moved in. I didn't really care about the house from a sentimental point of view. I really just cared about the house from a financial. It was an investment in my mind. So when
Yeah.
you think about it, borrowing against the HELOC, there is a risk with losing your home, but at the same time, it's a version of house hacking.
Yeah. I think it's a great tool. It's talking about like Dave Ramsey and stuff. This is good debt. If you're using the HELOC to invest wisely and you're mitigating that risk with hard money lending, I'm lending the money out and it's a first lien against someone else's house.
Even
And
better.
so there's another house before I lose my house.
Exactly.
So,
Yeah, that's a good way to look. We're mitigating the risk in a calculated way. And at that Dave Ramsey thing, it's like he says, it's a giant credit card against your house. But at the same time, when he tells somebody to downsize because they overbought their house or their house is a financial burden to them, he says, it's a house. There's one on every corner. I'm like, you got to pick one, Dave. It's either there's a house on every
right.
corner from a sentimental mentality, or you're risking your personal home. You can't have it both ways. And so I had to take on the thing like, hey, it's a house. There's one on every corner.
Yeah, for sure. Absolutely. And one of my goals one day would be to get my home paid off, traditional mortgage, but I think I probably will always have that line of credit there just for liquidity and
Yep.
investment opportunities, and like you've done, revolve that if it's making money.
Yeah. So
So,
you did your first hard money loan with basically your potential competitor.
yeah, yep.
Thank
And he's
you.
still a good friend slash mentor to this day, but yeah, so he originated the loan, partnered with him to put some money in, and 4 months later, it paid back, and it worked out really well too because it was right in Blackfoot where I was working, living, and so I drove by it, and it paid back a few months later. Then I had a partner at the time in my business. Soon after that, we started trying to get some partners as well to bring the capital and originating loans. So I think I got paid back in late September, and we did like our first loan in October.
Where did you find that original capital to be loaning out? Because the way that our fund is structured, we syndicate loans so people can put in $50,000. Well, before I started this fund, I called up one of our local hard money lenders. This was before you and I met. And I said, hey, I think I had a big check for whatever reason. I think we just sold a property or something. I had a chunk of cash. I was trying to figure out what to do with it because I didn't want to buy another building. Because every time you buy a building, that's another 5-year commit to running that building. And I was trying to retire. And so I was like, "I need to do something else with this that is not like a long-term equity investment." And he was like, "We take checks from 500. I don't think I could use 1,000,000 like that." He said, "I already have a couple of $500,000 investors. If I had 1,000,000, I wouldn't be able to put it to work." And I was like, "What about the people who just want to put in like 50?" Because I was from the syndication world, right? And so the way that we legally structured ours was a bunch of investors coming together, some writing very small $50,000 checks. So how did you structure that first one, and how were you able to get your first investors? Because you can't do much with 80 grand when you're buying houses. Like, you have to pay you're the
Yes.
mortgage. Like, you have to have the whole amount, most of it, minus their down payment. So how did you fund that?
Yeah, so we kind of in the industry, they talk about maybe like the direct placement or co-lending model. So
Mhm,
I compare it to joint venture. On deal by deal, I bring in this co-lender, this other capital partner, whatever you want to call them, and we sign a participation agreement, kind of like a joint venture agreement, saying we're funding this loan. These are the splits of who's getting what. We all have this undivided fractional interest in this note in deed of trust. And so all the loan documents, all the borrower facing side is under my company's name. I do try to put money in each loan and up to this point have and continue to plan to,
mhm,
and then get that investor or multiple investors for the rest, get a
mhm.
partner on that loan.
Okay. Oh, sorry. I was gonna say, like, my hard money lender, he had one partner that he always wanted to be in second lien position. So he would do a co-borrower with me every single time, and then every once in a while, this one guy would come in and fund it, and it had to be a 2 lien structure, which I don't know why he wants to do it that way. That's just the way we do it. So how does the lien structure work when you have more of the co-borrower? You just have fractional interest in that first lien together, or
Yeah, so it's a fractional interest on the public document. It's, when you get a mortgage and they sell your loan
Mhm,
and it's, oh, you're making your payment to this person.
mhm.
And sometimes that bank might sell your loan, but you keep making the payment to them and you didn't have to sign any new paperwork. So all the paperwork and public liens are under J&R Capital. And then essentially we're selling this undivided fractional interest behind the scenes to these co-lenders. How our paperwork reads is, yeah, we all have this fractional interest. So we all share that first lien. If it was a $100,000 loan and say for whatever reason things crashed and we only were able to recover 50,000 of this, don't ever expect that happening, but just for
I hope not.
conversation purposes, now it's only 50,000. We would all equally pro ratally lose that other 50,000.
Okay, so if you have 100% share interest among you and you split that up, let's say one loans 80,000 on 100,000, you'd own 80% of that first lien, and whatever monies were recovered would be split according to the same pro rata. Okay, that makes sense. And I think it's a pretty common way to structure these, correct?
Yeah, there's like hard money bankers. They have like podcasts. They're well known in the industry. It's on the East Coast, and that's how they structure them as well. And that's where we got the idea of land from a friend in Utah that I did that first loan with. That's how he structured it too.
Okay. And then tell me a little bit about the difference that you brought up the East Coast. That's interesting one because a lot of people will tell me we're loaning money out at 12%. We're charging 1.5 points, maybe 2 points is pretty industry standard in the Mountain West area. But people say, oh, you could get more for hard money loans. I'm like, are you from the East Coast? The person telling me that because I feel like they charge more. They charge a higher interest rate and they also charge higher points. So can you talk to a little bit about some of the regional differences you've seen with the industry standard on what these loans, because we have to loan competitively with other lenders or we're not going to get, or if we charge more points, we're only going to get desperate borrowers.
Yeah. No, you definitely do see a change throughout the regions. Like I know in this mastermind I'm part of, a lot of the guys back from the East Coast, I think they're charging like 3 points and 13%. And here I'm typically charging 2 points and 14%.
Hmm.
And that seems to be pretty competitive in Idaho. I know some others doing 3 and 14 and deal by deal as well. So yeah, it definitely will change. And yeah, I have a counterpart who's running a big debt fund, and maybe on a sketchy deal, will give a really high fee, quote 10 points or something. And then they're like, yeah, we'll take it. Oh, great. This is a scam for sure. This is the fraud. Something's wrong. They're paying that much.
Yeah. People do that with us every once in a while. They'll be like, hey, we got a loan. It's first lien, 18%. I'm like, what's wrong? What's wrong with it? Because if you're way outside the industry norms, you got to ask, like, why are they willing to pay this much? Why can't they just go to a hard money lender and get it? Because we lived in Texas when we didn't do our first hard money loan in Texas, but that was where we started looking at hard money loans for the first time. And they were all 12 and 2. So when we got to Utah, they were also 12 and 2. And so I did a private loan at 10 and 0. And for those of you who are listening, we should define our terms here for a minute. Could you explain what that means? Like 12 and 2, 13 and 3. What are the points and what is the interest rate?
Yeah. So the points is an origination fee. So it's a fee you typically pay upfront or bake into the loan, a percentage of the loan amount. So $100,000 loan, if you're paying 2 points, you're paying 2% as a fee just to get the loan. And then the interest rate typically be an annual interest rate. So 12% or 14%, the interest is going to accrue at 12 or 14% annually.
Okay. So if it's 12% loan, that's equivalent to 1% per month. And some of my hard money lenders will have me paying that 1% per month, like basically for month one. I'm making that payment, whether the place is vacant, renovated, doesn't matter. I'm making that payment. But I've also seen like the way we structure it is they don't make payments for the first 6 months. And then when they renew, it's a 6 month term. When they renew, then they'll start making monthly payments at that 1% per month. So when you're thinking about it, it's like we say pay 10 to 12% annually on ours. It's up to 12% because your money's not going to be working 100% of the time because it'll be between deals. So can you talk to us about making sure that your money stream matches your deal stream? Because I feel like that's one of the trickiest parts of what we do.
Yeah. As a lender, capital's out working. Yeah. It seems like it's a big seesaw, right? It's like at times you feel like you have so many deals and you're still a pinch to get more capital. And then at other times, and you never want to turn people away for lack of capital because you want to be the guy that they always go to. And then at
Yes,
the other side of that too is, yeah, if you get so much money raised or you're sitting on so much cash, you're not getting that return unless it's out there working. And then also if you're working with investors, you need to keep their money working too. Because if you've only got it out there for them every 6 months or something, then really that return's not as good as maybe they'll just go stick it in 5% CD for a year versus 12% loan that's only for 6 months of the year.
exactly. The blended return is what we're really after. And sometimes when I'm talking to people who have a chunk of cash and they're like, oh, I'm thinking of lending, and they think it's just going to be like no work. Honestly, I'll tell you, like private lending is the easiest money I make, but it's because my RIA partner sources deals and services the loans. And so I'm out there working with investors trying to bring in capital and he works on the deal flow side. So to me, it's like my money's out there working. I have someone I really trust to find deals and to manage the deals. So I'm doing my small portion. So for me, it's really easy. It's almost passive. Obviously, the marketing side and investor relations side is not passive, but on the loan side, it's extremely passive. And so people talk about, oh, I'll just go, if he can lend it out at 12 and 2, I'll go do that. But keeping that balanced all the time and making sure that as soon as your money comes back, you have a new deal to put it into, I don't know, it can be tough.
Yeah, for sure. And like you want to pick the best deals. And if you have a large pool of capital and you can have a lot of people deal flow, and yourself or I could pick through and do the best loans. If I'm just manage $500,000 at a time, then I just hope the timing's right for the right deal. So yeah, definitely that's why the benefits of working with like in a fund like yourself or with a lender like me is that it's you hands off and you can keep that money working consistently.
Okay.
So it's a full-time job.
It is. And why one of the reason I was reluctant to start this on my own, because I would see the hard money lenders at the RIA basically out there every month. handing out flyers, chatting, "Do you need a loan?" Or especially when you go to a real estate conference, like one of the larger conferences and you're in the exhibit hall and you've got all the big hard money lenders out there, like the national guys. And you're asking them like, "How do you fund all of these deals?" Because they are hunting hard for deals. And like, "Oh, we have a hedge fund backer, we've got a Wall Street backer, or institutionally backed," whatever the answer I always ask, and those are always the answers they give me. They have more money than they know what to do with. So they're out there really having to market hard to get enough deals to keep that much money moving. And so for the do-it-yourselfer, mom and pop lender who's just lending out your own money, you just have to know that you have to go find deals. You have to be able to underwrite those deals to know, are they any good? If you put a lien on that house, is it even a house that you want? And it is going to cover your loan amount? Did you overloan on it? So there's a lot there. It's not just as easy as finding someone who needs money and loaning it to them. You got to underwrite that loan just the same way a banker would underwrite before they put a mortgage out.
Yeah, absolutely. It can be very passive. But if you're going to try to do it on scale consistently, then it's, it takes time and effort and skill too.
Yeah. Could you define hard money for us? Because I know that this is sometimes a little bit of a confusing term for people because they're like, what does that mean? I used to think it meant like hard nosed, like they're hard, you're take your house or loan shark type of thing. Can you walk us through like how these loans are structured? We're talking about a bank underwriting a mortgage. That's very different than how we underwrite our hard money loans. So you as a former banker, compare and
Yes.
contrast those and where that term came from and how it's different than a traditional mortgage that most of us are familiar with.
Yeah. How I define it and look at it is that hard refers to having a hard asset, or another terms for a hard money lender might be an asset based lender or a balance sheet lender. So looking at what someone has on their balance sheet, or usually in my case, just that individual asset. So we're not so worried. I'm not going to go out and get tax returns, look at some may or may not pull credit scores, whatever other due diligence that the bank will do, bank statements and such. We're primarily, is there value there in that asset to protect our loan? And is it a good home, apartment complex, whatever that is? And as a hard money lender, that's what sets us apart, is we can be a lot more simple, quick and streamlined on that. If someone comes to me, I funded deals as quick as 24 hours. I don't go around touting that's what we want to do every time, but we've done it when we needed to. And that's because I can get in there and quickly pull comps on the property, find that the value is there. And if there's enough, if our loan to value is good enough, then we can make it work.
Yeah, and these are business loans. I think that is something that some people don't understand. It's like, "Oh, I want a house hack, so I'm gonna get a hard money loan, buy a house, then I'm gonna move into it. I'm gonna do a live-in flip." You absolutely cannot move into the house that you are getting a loan on. That would be a mortgage, has to go through a completely different process for owner occupied versus a business loan against a property that's being used for commercial purposes.
Yeah, absolutely. That's what I always tell them. We don't want to do owner occupied or consumer purpose. It opens up a whole can of worms of regulation and just
Dodd-Frank,
investment purpose. Yep, exactly.
yes,
Till all this stuff.
I do a lot of Dodd-Frank stuff because when I first started, I was selling all my houses on seller financing. And so once you do a certain number of those loans for owner occupied, yeah, we're subject to the same rules as Dodd-Frank. And so I've dabbled in that as an owner, doing a private loan to the owner occupant, definitely different ball of wax than hard money as far as regulations, how you underwrite that, a very different process.
Yeah, it's not an area I want to dive into and figure out.
How about on the commercial side of things? So we do loan to small commercial deals. Our loan size is somewhere in that million-ish, just north of a million range. So we'll do a lot of like 750, 850, 1.2, things like that on smaller commercial stuff. And we don't underwrite that any differently than we underwrite our residential houses from the borrower standpoint, but the databases that we use in order to get our numbers to baseline. 'Cause I think the question is, do I want to own this property if something goes wrong with this loan? If the answer is yes, then go ahead and do the loan. If the answer is no, and so you have to go through a process of finding out, do I want to own this? So do you do any commercial lending and how does that differ than some of the residential properties that you underwrite?
Yeah, I will do some commercial lending. I just haven't done as much. Most of my deal flow has been single family fix and flip in Idaho. But I recently closed on a kind of historic commercial building in downtown Pocatello.
Mm,
And I think it was like 12,000 square feet, pretty old. It was a bar at one point. They're going to
mhm.
put apartments up top and some other retail space on the main level. And yeah, the thing is, single family, like flip homes, are very liquid when it comes to real estate. There's
Yes.
a big pool of buyers that can go out there and get qualified to buy a home like that.
Yes.
Commercials, not as liquid, right? So you could sit on it longer. And so I underwrite it kind of like you were saying in a similar way that we're looking at value, but we're probably going to want a more conservative loan to value. So
Mhm.
we're going to want to lend less of that value of the property. It's probably going to maybe be a little more expensive of a loan. And, but yeah, we'll do them. And we, just like you said, is this a performing property? What does the market look like? If I had to foreclose, can I recoup that value? Because there's a big, that's the reality of it is if something did go south, like one, you want that borrower to have skin in the game that they don't want to walk away from it. And then two, if for some reason you end up with it, can you liquidate that and recover hopefully your principal, interest, fees, and everything and be okay?
Yeah, it's exactly. It's what do you do with a non-performing loan? Like, we don't sell our notes. So some of the larger funds that we were mentioning, they'll take non-performing notes and they'll package them up and sell them at a discount to somebody who's going to go rehab the loan. It's almost like flipping a loan versus flipping a house. They're going to go take over the property. They're going to try and get that borrower to turn into a performing borrower. What there are all sorts of things that they can do to rehab that loan. And I don't want to do that because basically what happens is you take a loss on that loan and then how are you supposed to pay your investors back for that? So in a pool, a blind pool investment, they just say, okay, we're only going to pay 8%, even though we're charging 12 or 13 or 14%. We're going to pay you 8 because some of it's going to be losses. Sometimes your money's not going to be working. Just stick it in here, leave it in here all the time. And you're just not going to make as much in that situation, but it's a lot safer because they've got that volume versus having it leaned against a single property, which something could go wrong. And then now you own a house, it's leaned, and now do you even know how to flip a house? So that question is, do we want to own this property is how we manage that risk. It's if we're going to do this or not. What's your plan for if you have a note that doesn't perform? Like the first call you get, hopefully they call you and be like, hey, I'm struggling. What happens at that point?
Yeah, really, my goal is that this is a win-win-win, right? Like it's a win for the borrower, win for myself, and win for any investors I'm working with. And so that communication is so important as a borrower. Some people just want to stick their head in the sand or hide or like just be quiet until things like we're going to forget about them or something.
Yeah,
But
right. I don't know
it's,
about
hey,
it.
you have
Real?
$400, just it's fine.
Yeah.
But so most of my loans are structured like an initial 6 month term where
Right.
they'll have no monthly payment during that time. And it's pretty common that they get to month 5 and they're still finishing rehab or they are just about to get on the market and just need some more time. So in a situation like that, usually it's just like, all right, it's a value add property. Like I'll go on the property myself, get some pictures, whatever it is, and see that value's been added. And so in that case, usually we're even in a safer position at this point because things are going towards plan. And if
Mhm.
that's the case, we'll work out an extension and give them some more time for a fee, maybe start collecting payments or something. If something's going wrong and they're just not communicating, the property is not being performed, or the business plan isn't being executed, at that point, then it's that far end of the spectrum is that we start a foreclosure. And in Idaho, what that looks like is there's notice of default filed and all this paperwork is done and public notice is given. And then it starts a 120-day clock before a public auction. Because a lot of people say, with lending, you just get that property back, no big deal. You can just take it. They don't pay you. There's a process to it. And so
Mm.
120 days, if no one bids at least our which is going to be our full payoff with fees, and we would get that property back.
Last case
Close to
scenario.
90 loans, it's the last case. Usually it's, hey, let's communicate, let's make some payments, or what can we do to keep this going? They're still working on it, and I am in a secure position and we'll work with people.
You're not in the business of taking over your we do not want it.
Exactly.
Like, we're not flippers. If we wanted to flip, we would flip.
Yeah. And that's why I think it's important to borrow with local hard money lenders too, is who they are. It's not some national scammy loan to own type program.
Mm.
It's someone that's done business with me before. I guess as to that, I had a loan on my books. It was a multi-use property. We did the loan in 2022. It was I think, 10, 20 acres, and then it had triplex and two single family homes on it, and then just went to bare ground. We started out with the longer term. He was going to use the funds to build some duplexes and some other things. Long story short, the loan has gone long. We've worked with him and done some extensions. He's continued to make a monthly payment, and it just paid off last week after from 2022. So it's been a long time. I had him thanking me like, "Hey, thanks for working with me. I set a record for the longest hard money loan." And the investors got paid. That took a long time. That was okay. It was a good return. Thanks. I appreciate working with you too. So really, at the end of the day, everyone was happy. We had I think our loan was 400 something thousand. The bank appraised the whole property like 1.5 million. We had plenty of equity to protect us. He was making his payments. We were paid. And so it was a win-win. And
Thank
so in
you.
situations like that, we'll work with people. It's just, we gotta have to stay protected and stay in communication.
Yeah, communication. So key there. It just shocks me sometimes some of the lack of communication that goes on in the business world. You're like, hey, we're all supposed to be professionals here, but it's a real problem. So the better you get at communication in general, it's going to help you like in your marriage and your parenting and your business. It's like communication is key. And I just see the breakdown of that again and again, causing people more problems in business and relationships than pretty much any other lack of any other skill. That's my top one. I don't know, like, this is a little bit of an aside, but what would be your top skill? You're like, "Hey, if you wanna be successful in general, like, you need to have this trait or skill or ability."
Yeah, that's a great question. I think
Spread it on you,
communication's
sorry.
definitely close to the top, and resilience, I think, is so good
Mm,
too, and just be able to, like, go with the punches, and things are gonna change and not like you expect, and be able to roll with it. So, I'd say, like, communication and resilience is good, and I think just being kind in all situations, it sounds whatever, but kind and humble and just, like, work hard and realize we're all humans and trying to do the best we can, and even in business situations, we have to make business decisions, but there's still a human element in all of it too.
yeah. I feel like integrity for me is way up there, like, almost radical honesty, but at the same time, assuming nobody else has any integrity. It's because you wanna
Yeah.
be resilient, but you also don't wanna get taken.
Yes. Yeah, integrity is huge, like, being as transparent as you can be and honest with people, but then watching your back too, because you don't know if other people have those same values.
Exactly, and most people do most of the time. When you're defending your own cave, suddenly the claws come out. I think you can see that with a lot of situations, which I guess I understand. If you look forward in your own career, right? It's like family is the most important thing to us. Like we're doing all of this so we can spend more time building the relationships with the people that really matter. Like I feel like I have a lot of friends in the real estate world, a lot of colleagues. Like, you could call me up at any time and I'd be happy to hear from you and we're gonna talk. But I feel like if it was between Avery and the kids, you see what I'm saying here? At a certain point when you're defending your own cave, it's like you gotta put first things first, and that is I think that's been tough for me in the past when I have partners who, rightly so, should be putting their family before something that's going on in business, and sometimes I feel like maybe they pull the trigger a little too fast. Your family's fine, but they're always looking out for number 1, they make it about their kids, or they make it about like, I feel like you're trying to pull one over on me because you have kids, but so do I, and you're pulling one over on my kids too. So that's a real challenge for me on how to balance those relationships, taking care of family first and having that be the priority, while at the same time still having high integrity in those business obligations. I don't know. Have you ever thought about that? Have you ever run into that issue?
Yeah, I mean, it's a challenge because that's a invisible hand that uplifts our economy, right? Is that we are selfish, we have our self-interest, and we look out for ourselves, right? But balancing that with that there is abundance and enough for everyone as well, and that there can truly be collaborative win-win situations. Yeah, I always have a hard time reading that too and exactly how to balance it. I'm still learning that all out, but I think we have to put our interests there. But if we can try to balance that and look out for others too, it's an ongoing juggling act for sure.
Yeah, it can be really challenging because everybody has a different point at which they say family first. Yeah, you know what I mean? It's like some people are like, "Oh, as long as my kids are fed, clothed, sheltered, all of that." And other people are like, "No, my kids have to go to this private school." And that line is different for every person. And so maybe that's one thing you communicate about before you do a deal with somebody. Really get to know where business ends and friendship starts and where business meets personal because it's different for everybody. My kids are adults now, so I don't have as much of an obligation to them financially, but they definitely will win for my time every single time. But financially, I'm much more open with my partners to be like, we're all going to make it. And you're not taking food out of my kid's mouth. It's very different when your kids get a little bit older, I think.
Yeah. And like you said, others might be saying, I've got to build this huge trust fund for my kids and I need to keep this as much as I can for generational wealth.
Okay. Oh,
Yeah.
that is a very good point because I do not care very much about generational
Yeah.
wealth to remind myself, like, oh, we're supposed to be building a legacy here. But yeah, that's true because I have actually seen that now that you mention it with some of my partners. Like, it's like they're so into this legacy thing and building legacy wealth that, yeah, even their adult kids can sometimes get put ahead of their business relationship because, like, I don't know, I don't want to say that's ego. I think generational wealth isn't necessarily about ego, but maybe putting it above present interests and present relationships can be a little bit about ego.
I could see that. You don't need wealth to be a good person, but it certainly helps. It can help good people do more good things.
Mhm.
Sometimes you see these philanthropists or whatever people fight for cause and they're anti-capitalism, but they need capital for those good causes, right? Good people with good resources can do more good things, better your own life, better others' lives. So it's not the end, but it sure helps.
It's like having the right tool, honestly. Like we just got back from ice skating and my daughter was a little too scared to get on the ice because we had a little bit of a roller skating mishap a month or two ago. And she just didn't want to put the skates on. I said, let me just walk around the ice with us. And so we're holding her hand and she's walking around. She's 12. She should be able to ice skate, right? But she just wasn't up for it. And she was having a very different experience using a different set of tools to walk around the ice with her shoes versus us on skates. And she was like, you guys are going too fast. I can't walk that fast. It just got me thinking about the tools that we use and how we employ them becomes very important and you can have a completely different experience depending on what's your purpose of being out there, what tools are you using, really thinking to yourself, like, why am I doing this? Who is it for? What are my standards? Where when meets the road, like, which side of that am I on in a crisis? And so that's when you really get to know people is when there's a crisis. And what we're talking about here, we're talking about money, a full house, like a whole building. The stakes can be high.
It can be. It brings out the best and worst of people for sure. I think working on yourself as you work on your money is just as important. And I think too, pivoting a little bit, but I was sitting in a meetup group the other day and there's people of all different levels in their real estate and wealth building journeys. And we were talking about people were talking about some big projects, multi-million dollar projects. And I was thinking about some people in the room that are probably like just overwhelmed with that. Like, yeah, I'm never going to get to that level. But I think just whatever is in front of you, taking those opportunities as they come. For me, it started out, I'm going to maximize my 401k match and put as much in that as I can right now. The stock market's available to everyone. And then before I got into this, I invested in one industrial building syndication as a limited partner. Just putting I had that opportunity in front of me. It made sense. I did that. And then now continually these new opportunities keep coming and I'm able to take advantage of them. So just taking kind of your steps as you have them and whatever opportunity that is. Like right now, if there's not much there, maybe it's just buying some fractional shares in the index fund. And then as that grows, then you're investing in some more real estate, but taking those opportunities as you have them.
Yeah. I've got two questions here that I want to ask you. Back up a little bit. I run into this a lot with borrowers. They're like, they think that they can borrow 100% of the purchase price of the house from a hard money lender, or they're trying to get a traditional mortgage and then use a hard money loan to make their down payment. Do you run into this a lot and you have to educate the borrowers? That's not how this works. Because I want to talk to some of our listeners who may be thinking about borrowing or doing some flipping. Like we have listeners who are like, I'm never doing that. Passive investing only. And others who are like, yeah, how do I do this? So talk to the borrower about how these are structured, loan to values and lien positions, and figuring out like you can't borrow the down payment money because then that would be in second lien and blah, blah, blah. So give us a little bit about that.
Yeah, absolutely. So a lot of investors want as much leverage as they can, right? And so all the time I get requests for 100% financing. And how I always kind of look at it is I'm not going to take equity risk for a debt return. And then, so if I'm going to
Mhm.
take it, I need to take a debt risk and get a debt return. We get
Yeah.
a fair return as a lender, but the person doing the project has the most at risk should be getting the biggest return if the project goes right. And I would be taking a lower return for the risk involved if I gave them 100% of financing.
Yes.
And
I love
so,
that. You don't give because equity is higher risk. Don't take debt returns for equity level risk. Yeah. That I'm gonna remember that so I can tell people the next time.
yeah. And yeah, so where I'm at, like we're typically of the after repair value property is done. If it's a flip, we're not wanting to lend more than say 65% of that, give or
Mhm.
take. And most of the time I'm just lending 80%, maybe 85%, give or take of the purchase price. And
Yes.
they're bringing in their own down rehab funds.
Okay.
Now, sometimes I do go out there and find individual like private lenders that will give them that second lien debt, or maybe they use a HELOC or so. I always look at it like a bank is willing. like all these mortgage products, like they'll lend you, maybe 95%, maybe 100% for that property, but they're going in, they're looking at your income ability, all these things that you can repay this loan outside of that asset. I have no idea on that stuff. And so it's the asset that's going to protect me, and I
Mhm.
can't risk it at 100%.
Yeah. So I think it's important for borrowers to understand you do have to bring money to the table because you're gonna have to pay those points up front, that fee up front, and you're gonna have to bring in some sort of a down payment. Whether you do that with a partner, a private partner, bring in a partner to the deal, you're gonna make less money. But broke people owning real estate, that's where Dave Ramsey comes back. It's like this do you have no emergency fund? So not only do you not have enough money to come and bring the points and bring the down payment to this, but you also have no ability to deal with any business plan that doesn't go 100% according to plan. So I personally don't want to lend in a situation where the person doesn't have the ability to execute the business plan the way that needs to be done. Skin in the game, I think, is one way to put that. But another is just to be like, what are you going to do when the ship starts sinking?
Yeah. If something goes south, what are you going to be able to do? And like, I get it. Like, getting high leverage deals is great, but you still need that liquidity and things to handle those issues when they come up. Like that RV park we talked about at the beginning, we
Mhm.
actually bought that we ended up using the hard money loan for now to bridge it. And then the seller carried a second lien for
Mhm.
our 20 to 30% for the down payment. And so at the closing table, it was just about $3,000 to lock up this whole RV park,
What?
which is,
What? That's a change from the last time we talked about this because last time it was like a couple hundred grand down payment. So you're getting a seller financing lien on it. And then you were having to bring in basically joint venture partners to bring in, we don't have to talk about specific numbers, but somewhere in the low six figures to get this thing closed. So tell me about that deal structure. And then once you're done with that, tell me about your business plan and how you're going to add value to this property.
yeah. The plan was to get a bank loan for, say, 70% of the purchase price.
Hmm.
And then the seller carried that 30%. And so he was willing to get paid for closing and carry the rest of that, which on awesome terms is like 6% for 5 years. And it
Nice.
all just balloons at the end. So we don't even have to make a payment.
Wait, what?
Yeah.
What's the one to sell it? Because he was playing such hardball, like, how and you're like, "No, we know that you're not just gonna go sell this right out from under us." And so he sounds like he kinda had to play ball in the end.
Yeah. He ended up being pretty willing to play on those things. And we gave him what we thought was a little better price than what it was worth today. But we
Mm,
saw a ton of value add as well. And so, yeah, we ended up getting that. We used a hard money loan just for timing. Our bank got the ball, but we're working on that refinance of that first lien right now. And then going forward, our business plan is you could call it maybe like a low class C like neighborhood right now. Like it's poor condition, right? Like I think there's probably some drugs there and some
probably, definitely.
probably guaranteed. Yeah, definitely. And so our plan is get it to operating like a true RV park, getting people that on that summer peak season, getting some nightly stays. We'll let people book 28-day intervals. We are going to bring some capital to the deal to do some improvements. Right now, the office is out of the manager's camper and it's like a little shanty thing. I just posted on Facebook and I'm like, hey, do you think this looks good or should I keep this just like this?
Yeah.
We wanted to improve the aesthetics of the park, pave some roads, get an office there, and then just they haven't done any marketing and online presence. So we plan on converting all the way to online and get some marketing going to hopefully add a lot of value to the property.
Yeah, because I felt like it's right on Highway 20 on the way to Yellowstone, so there should be some decent tourist kind of traffic coming into there for once you get to the point where it's not just long-term people who heard word of mouth that you could deal drugs here and not get in trouble.
Exactly. Yep.
Yeah, so going to have to do pretty much a complete tenant turnover, like different class of tenant and reposition the park as a different type of business.
Yeah, we will go in and everyone's on month to month leases right now. So come March, we'll give notices that those leases are ending, but they're welcome to go apply for their next 28-day stay on our website. And we're going to have some park rules, which will cut out quite a few of the tenants already, just with the condition of their trailers and or not paying or whatever that may be. So I imagine a lot of the people will be leaving, but there'll be some that will be able to stay that are good performing
Yeah.
tenants as well.
Yeah, you'll always have some people who are there because it's affordable, but they don't like what's going on. And then when you start to turn it over, even if you have to raise rents a little bit, they'll put up with it because they're like, oh, it's clean. We have nice managers. It's professional. The transition can be a little bit rocky, but eventually you turn up like, who wants to be here? Who's clean? Who's going to play by the rules and wants a nice, safe community to live in that's also still going to be affordable, but at the same time, be able to pay for its own upkeep. That's really the goal, the win in that
Yeah,
situation.
yeah, exactly. So, yeah, we think it'll be a benefit to the community to get it turned around, and we see a lot of upside to it.
Yeah, it's an exciting project, and I think this is a good example of networking. Let me just briefly tell the story where that apartment building that we own in Pocatello, Idaho, I was just posting on LinkedIn that we were looking for some investors to come and partner on that one, and I had a man from Utah reach out, and he said, "Hey, I'd like to put some money in this deal with you." And we just clicked right away, right? We talked on the phone a couple of times. We put it in. He's got his money. We still own that place. He's still got his money working. And he and I tried to do a deal together in Texas that did not go well, which was pretty disappointing. But again, developing that relationship even more during that period of time. And when he told me about this RV park, I'm like, know a guy that I met recently. I remember the first time you and I talked on the phone, we were at our RV park in Texas. I was walking around it while you and I were visiting. And then months later, this other RV park opportunity came up and you had mentioned that you had the mobile home thing that you were looking at, or maybe you want an RV park, whatever, that introduction. So this is just a little anecdote of the power of networking and how these relationships, because you found me on LinkedIn as well. You're like, I'm a hard money lender. She has this RV park. Like maybe I might want to invest some money with her. Like even though we're running our own businesses, we still invest in one another's businesses and then degrees of separation, right? Suddenly, and you meet I mean, we've introduced several people to one another, but so they're not always going to click, right? But then you are doing a deal. So tell me a little bit about that from your perspective, that value of networking and where these things can possibly go.
Yeah, it's huge. I owe you a ton for making that connection.
Yeah, you
This
texted. Don't worry.
Yeah.
Wait.
Yeah. Well, networking is huge. Like the saying, your network is your net worth. I think networking has provided me all the opportunities I've had today. The hard money I got from going to RIA groups and learning about hard money. The borrowers I lend money to, I got from going to these meetup groups and meeting people who need to borrow money. The investors I work with to partner on funding the deals, people I've met through my network or other people's networks and just called and talked to and built relationships with. So it's so easy to sit there and say, be a cynic and say, I don't have these opportunities or nothing like this ever happens. Did I ever think I'd be buying an RV park for $3,000 down or my partner's $3,000?
Yeah.
And
Sure.
yeah, and doing that, I think that opportunity was going to come. No, it just seemed like you would hear it on Bigger Pockets, but it's like, how does that happen? By staying consistent to meet people, adding value where you can and taking those opportunities, work is huge. And that's how businesses do it.
Yep. I'm going to come up and speak at the East Idaho RIA. You invited me to do so. By the time this publishes, it'll already be done. But it's just another example of how networking is coming around. Hopefully, while I'm there presenting, I can meet some people who might actually want to invest with us. And even if they don't invest right away, these kinds of things are long term and you don't know where they're going to go. 90% of them, 99% of them maybe are just friendships. Like we were talking about at the beginning, like we're friendly with one another. Last year was a tough year. We had a couple of investors in our local community pass away. And it just seemed like we kept meeting at funerals. But when I was looking around at the funeral guests, I was thinking like, these are our friends, right? And we went to a wedding, a couple of weddings, and we're looking around and these are the people that they're inviting to the wedding. These are people showing up to the funerals. Like these are not just business connections. Like these are true friendships that we have as a result of these networking connections. And the people who got married, I think I've only done a deal with one of them. And then the people who passed away, I hadn't done deals with any of them, but we were always looking. And it was always just one of those things where you're just always going to see where is this going to go? Most of them just end up as friendships. That you'd never know when one's going to turn into a business opportunity. It's more often going to end in a friendship than it will a business opportunity, but we keep looking because that's where they come from.
Yeah, absolutely. I should give a shout out. So the lender I first connected with, Matt Strong in Utah,
I
he's
borrowed
actually this,
that.
I-
A lot
he's
of
the
them.
guy that came to the plate and gave us the money for the RV park, right?
Oh, nice.
I invested with him, we continue to connect. We've partnered on some loans together. And now I borrowed money for him. These connections are huge.
That's kind
Give
of
it a
funny.
call.
I know when I did the Bigger Pockets interview, I was talking about how the first meeting I went to, the guy was talking about if you can just skip residential, go straight to commercial, you should do that. And so I raised my hand. I said, what if we have capital and we want to just skip? Somebody asked him, like, what would you do next when you retire from commercial? Because I'd just be like the money partner. I'd just be putting the money in. I said, what if you can just go straight to being the money partner? And he's just laughed. He's like, then you should do that. But then I ended up buying our high rise project from him. He was the broker on that deal and connected me with the seller in that situation. And then the lender on it was Matt because we could not get enough money raised from joint venture partners. We were coming up short and he came in and put a lien on that so that we could do that. So that's just, it's a small world. This is another community notice. Have integrity because we know you and we know people who know you. And if you are difficult to deal with or dishonest, like people can find out.
Yeah, you could do one bad deal where you didn't have integrity, or you could do a lot of good deals where you did have integrity. Word gets around. It is a small world the more you get connected.
Yeah. And it's like in that situation where I was doing the deal with your partner and we weren't able to purchase it and we lost our earnest money and things like that. And I called him up and I was like, hey, I want to pay you back the earnest money you put in because I am the one who invited him into that deal. I felt really guilty. And he said, no, we're big boys. Like we know with this, sometimes you lose money on this stuff. This is part of the game, all that. And I said, well, we just sold that high rise. Tell I have some capital gains. I could really use a loss on my taxes. He's okay. Here's my wiring instructions. So being able to just say, I just wanted to have integrity and pay him back. No, I'm going to have to pay taxes on this. I would rather pay you than Uncle Sammy's. I will help you out there. So integrity, but also again, win-win situations.
Yep.
Because maybe I would have paid less taxes than what I paid him for that loss, but there's no value on that relationship.
Yeah, you just showed your character and what you're going to be like to do deals with by doing that, and he's going to come back to you. And
Hopefully, if we can do a
yeah,
good job on this actual property that he's still invested on, we'll
yeah,
see. Clock's still ticking on that one, but yeah, Avery, great conversation having with you. Really looking forward to coming and speaking at your RIA. And honestly, I think this will be the first time. No, we've met in person before. Did we meet at Best Ever last year? Have we met in person?
no, I don't think we've ever met in person.
Oh,
Oh, yeah,
you have to tell me how tall you are. So when I see you, I know ours.
yeah.
She's taller than I
I'm
expected.
6'3". So
Taller than I expected.
yeah,
Okay, great. Yeah, this first time meeting in person, which is another kind of funny thing about networking, especially post 2020, is like there are lots of people I'll meet them in person for the first time, and we don't even realize we've never met in person before.
yeah. Like Matt Strong, we've never met in person. I've done a lot of business with him.
Okay, so when he came to speak at Urea, was he in or
It
is
was
this
virtual. He just got on Zoom or something like that.
yeah, he's not as tall as you, so you can know that when you finally meet him. A few
Good heads
people.
up.
But all right. If you want to get in touch with Avery, let our listener know how they can do that.
I'm on LinkedIn. I'm on Facebook as well. My company has a Facebook page, A&R Capital LLC. And yeah, if anyone always open to network and talk about real estate.
Yeah, and Avery means it. Like I asked him before the show, I'm like, I always ask, who should reach out to you after the show? And he was like, anybody who wants to talk about real estate. And he means it. So be sure to reach out and just have real estate conversations, ask questions, spend time with people doing what you want to be doing, especially when they're telling you a story. Like, I tried flipping, then I tried the house. We've been through the same process that you're going through right now to settle into our niche. And everybody who's going to celebrate a niche has tried lots of other things that weren't really a good fit. And then they finally found the thing that was their thing. And then sometimes it's only their thing for a few years and they move on to the next one, or like me, just try to retire. So I would also love to have a conversation with you. Like also let's just talk about real estate. Maybe you want to invest with me. Maybe you want to invest with Avery. Who knows? Maybe we just want to talk about real estate and you can introduce us. We can introduce you. This is how this whole thing goes around. Like, again, you never know where it's going and maybe we'll just end up friends. So reach out for sure at partnerwithrise.com/Emma to get on my calendar. I would love to have a conversation with you and help you plan out your next passive income adventure. So until next time, thank you for joining us.